So today we're going to talk about cost, volume, and profit relationships. And the reason why we want to look at that is because we need to make some decisions as it relates to the profitability of the organization. Remember we said as managerial accountants, we need this information to be able to make decisions. So one of the decisions we're going to need to make is which product lines we're going to keep as part of our portfolio and which ones we're going to spin off or discontinue. So the question is, how do we get the information that we need to make those decisions? And how do we know what is the target volume of production? So in other words, how many units do we need to make to break even? So the break-even point, who knows what the break-even point is? What is the break-even point?
When you're kind of wrote it correctly, when your investments are like your profits cover all your like costs. There you go. Okay. Is that when you're able to catch up to it? Revenue minus expenses equals 0?
You're close. You're close. Let's see if they, Alex could add a little bit to what you said.
When you did make a profit, nor did you have a loss. When things balance out pretty much.
Right. So, Melissa, you want to add to that?
No.
No? You're gonna pass, right? Okay. So basically, it's the point at which our yes. Now, yeah. Right. So we're not making profit. It's the point that literally that we break even. So our sales are going to cover our costs. So why do we care about that? Why is that so important? Because break-even analysis is something that managers do all the time. We need to know at what point we're going to break even. So in other words, it tells us how many units, or we could look at it in dollars, but it tells us how many units we need to sell in order to break even. So what are we going to do with that information? How does that help us? Think about the application. So you're a manager. So we have this manufacturing facility, and we're considering making a certain product. But we need to know at what point we're going to break even. How many units do we need to sell in order to break even? And the reason why that's important is because we need to decide whether or not we're going to be able to reach the break-even point. So is that reasonable? So what if it says, okay, the break-even point is 50 million units? Now, in some categories, maybe that's only 1% of the market. In other categories, the whole market might only be 10 million units. So you see why that's an important tool for us, is we don't want to just go forward and invest money in manufacturing equipment and in research and design to make a product and then find out that we have this unobtainable goal, which is that we have to, just to break even, we haven't even talked about paying Mary's salary yet, right? You forgot Mary's our plant manager? And Alex is responsible for sourcing plastic from Turkey for us. So we need to know, how many units do we need to be able to sell in order for us to break even? Now in some markets, it's 10 million. In some markets, it could be 10,000. But we need to know from our perspective as a business how many units, based on our cost structure, we would need to sell. And then compare that to the size of the industry. So is it realistic to think that we could sell 50 million units? Even if it was only 50,000 units, we got to challenge ourselves and say, is that realistic to think that we could sell 50,000 units in a one-year period? Very often, managers are looking for payback periods of 1 year. If you're willing to take a little bit more risk, sometimes companies are willing to accept a payback period of 2 years, 3 years. In pharmaceuticals, the payback period is actually much longer because they'll invest billions of dollars. Like a company, for example, like Merck Pharmaceuticals, they spend billions of dollars every year to do research and development, to find medications that are going to help people who have high blood pressure, diabetes, cancer, heart disease. It might take them 10, 15 years. And then they might finally have a payback after they introduce the product and it's approved by the FDA. And that's why prescription medications are so expensive. And people always get hung up on the variable cost, which is what? The cost to make the pills. How much does it cost to make one pill? Well, it might be only 3 cents or 5 cents. So how do they sell this for $5 a pill? Well, why? Because they spent billions of dollars. They invested billions of dollars into doing the research and development. And of course, that's why when the patent expires after 20 years, that other companies are able to produce the product and sell it at a very cheap price because they're not burdened by those research and development costs. Because to manufacture a pill is not very expensive. I mean, usually the ingredients themselves are not what causes the pill to be so expensive because of the years of research and development. So we need to know at what point we're going to break even. We also need to know what is the margin of safety. Who knows what the margin of safety is? The margin of safety as it relates to the break-even volume or the break-even level of sales. You had Mackenzie?
Difference between.
Oh, okay.
Go ahead.
It's the difference between the breakeven points and volume of sales you have at the end of a certain period.
Right, so it's what we anticipate sales to be for a given period, either what is budgeted or the actual sales, compared to the break-even volume, the break-even level of sales. So in other words, if our sales, let's say whether it's actual or budgeted, let's say our budgeted sales are $10 million. And the break-even level of sales is $7 million. So the margin of safety in this case is $3 million, right? So it means that when we talk about the margin of safety, it means how much can sales actually drop in the period that follows and us still be able to hit the break-even level of sales. Does that make sense? So do you think that we need to know that? Because we're going to be forecasting 3-5 years out how much our sales are going to be, both at a unit level, so how many units we're going to sell, and what the dollar volume is going to be. So with that in mind, we need to know, well, what if things don't go as planned? So we need to look at the best case, the most likely, and the worst case scenario. So once we calculate the break-even point, we need to know, well, what happens if a recession hits and sales go down 20%? So if sales go down 20%, are we still going to be able to break even? So in this case, what would the answer be? What happens if sales in the following period go down 20%? You can? What do you tell us? Tell us why, Greg.
Well, 10% of 10 million is 1, so double that is 2. 10 minus 2. I mean, yeah, 10 minus.
Yeah, you're right. Go
10
ahead.
minus 2 is 8 million, minus 7 million for the break even. You get 1 million above.
So in that case, if sales turn out to be 8 million, which it could be, we could say that the best case is 10 million, most likely 9, worst case 8 million. And we've already established that our break-even level of sales is 8 million, then we're still going to be able to break even. So right now, our margin of safety at a level of sales of 10 million, our margin of safety is 3 million. If sales actually go down to 8 million, then our margin of safety is now only 1 million. So who could tell us now, based on what we discussed, who could play back for us why this is important as a manager? So if you're the managerial accountant, if you're working with the executives in the firm, what are we going to do with this information? Why do we care about the break-even volume and the margin of safety? What do you think? Go ahead, Krista.
Forecasting, you have to forecast for like the worst possible scenario if you're a manager, so that the business doesn't go under.
Right, absolutely. And we need to know that what is the worst case scenario? So what are we getting ourselves into?
You also need to know at which point you're gonna get a profit, because you're not gonna be running a business for loss.
Absolutely. And how long is it going to take us? What is the payback period going to be? How long is it going to take us before we actually turn a profit? Anything else, Mary?
Which product will feed anyone that's not making money, get rid of it?
Right, absolutely. Which one to discontinue, and also which one we should pursue. So as part of our new product development team, which products should we pursue? So when we do new product development, we reach a certain stage in the process, and we have what's called a go, no-go decision point. So you spend a little, you learn a little. We research a certain number of concepts, whether it's for a touch tone phone, or a phone that has FaceTime capability. And then we decide, once we go through this analysis and determine the size of the market and the potential and how many units we're going to have to sell to break even, we could decide whether or not we're going to go forward. Because like we said, the break-even point might be even bigger than the size of the market. Why would that be? How would that happen? What's causing that? Why would the break-even volume be so high?
Lack of demand.
Demand? A lack of demand? Well, wouldn't it be the lack of demand? Well, it could be in terms of the margin of safety. It could be that there's not enough demand. Mary?
Make it, the products make it very expensive.
Right, it might cost us, our operating structure might be so high that it's very costly to make the product. And in a manufacturing facility, sometimes you'll have economies of scale, which in order for you to be profitable, you need to make, let's say, 100 million units for you to achieve, let's say, a high level of efficiency. We're still, trying to make 50 million units. How many units of the new iPhone 4S did they sell? Does anybody know? How many of you are getting the iPhone 4S? You got it already? You got it? Oh, Dallas? What?
2 hours for it.
Wow. You didn't wait?
I work for AT&T.
Oh, okay. Wow, that's amazing. So you had, did
I
you,
have
were
mine
you,
stashed away before.
so were you eligible for an upgrade?
Yeah.
You are, okay.
I waited.
There's people that are like, oh, I'm buying it $549. I'm
That's
like,
crazy.
really?
$599 for a phone?
Right, right.
I don't understand, can't people get it in like through the company and get mailed to them? Why would they wait online for super long?
Full week wait.
Oh,
Yeah, there's,
wait a week?
Yeah.
So you
Which-
I like waiting in line for that.
You like that? That's part of the.
Yeah.
I think that is it. They do create hype, but that's what they would tell you is that that demand exceeded the supply. But I think also to some extent it's poor forecasting on their part. And that's not really a criticism because forecasting is very difficult to do. So in other words, forecasting is anticipating how many units are going to be demanded in a given period. But still, I mean, come on, you've been planning this for years. Don't think that, people are starting to say, well, Steve Jobs passed away, what's going to happen, the company's going to fall apart. They have a new product development plan that's out 3 to 5 years. Why do you think every 6 months or 9 months they release something, they release a new iPhone, now it has FaceTime. Then they release it, now it has iCloud, right? I mean, they have everything all mapped out. They know what they're going to release in the summer and what the features are, and the technology already exists. All of that is already available. Yeah, Greg?
At the end of the day, I mean, it's always going to be best for the company to produce less. Because if they produce less, the worst thing that happens is they lose sales. But
Well, that's the risk.
It's still exclusive. It actually raises the exclusive. Now, if they produce too much, then they have to give it out for free, $50, and then the whole brand, broke down.
Well, that's the challenge. So Greg raises a good point is that there's a risk associated with producing too many units. And you might get stuck with inventory. And if you produce too many units, from an accounting perspective, we're concerned about tying up cash. We're tying up working capital. Remember we said that inventory is an asset. Why is it an asset? Because if you have 10 million iPhones in a warehouse, how much? At $549? Well, at a standard cost, which is probably like $15. I mean, come on. You're tying up millions and millions of dollars. And capital is not free. Right? There's a cost associated with capital. And we'd have to be paying interest on the money that we borrow to produce that inventory. And we talked about how we get there to the finished good iPhone, from raw materials to WIP, and then ultimately to finished goods.
Well, Apple, when they released the 4S, had to also think about the release times of other products that they were going to do, because they originally wanted to release the iPhone 5. I think it was October 25th. And they wanted to extend it out to different companies, and then they had to pull back that whole thing, and they used really shrewd marketing tactics to drop the iPhone 4S in replace of the iPhone 5, push that one back to Christmas.
Oh, so the iPhone 5 they say is coming out at Christmas now? Or?
Yeah, they pushed it back a bit. I don't know if it's Christmas exactly.
Marketing.
They pushed it back. It would have been the fun dropping the 4S at this price.
Right. Well, I would think they're probably going to wait at least 6 months, probably like summer.
That'd be terrible marketing tactics. You just had people drop $500-600 on a phone, and now 3 days later, here's a brand new phone again.
Right.
What's everybody going to do? They're going to return the 4S,
Right.
and then you lose the profit on that.
Business in general. I mean, that's what it always did. Computers, that's electronics. You buy something, and a week later they have a newer model that's even cheaper, and you're outdated already.
Oh yeah,
That's the
but
business.
when you have one phone, HTC can pull something like that off because they have a billion different types of phones.
Yeah, I have a lot of different models.
Apple has the iPhone.
Right.
They have
Well,
the
I'm
iPhone
sure
3.
that Steve, was a part of that decision, and, knowing that he was gonna leave us, that he said, introduce the iPhone 4S, 4GS, and hold the 5 until later, and create
Yeah.
some hype
Because
around that.
Remember, they released the 3GS at the same time as the 4, the original iPhone 4. That's what they wanted to do with the iPhone 5 and the 4S originally. Obviously, that didn't turn out the way they planned, but
Right. All right. Let's look at some examples. All right, let's look at the first exercise. Who's going to do that? On page 291. Yeah, this is about preparing a contribution format income statement for Whirling Corporation. All right, so what's required? Who's going to read it? All right, go ahead, David.
Prepare a new contribution format income statement under each of the following conditions. Consider each case independently. Number 1, the sales volume increases by 100 units. Number 2, sales volume decreases by 100 units. Number 3, the sales volume is 9,000 units.
Who is it?
Sorry.
The cricket.
Prepare a cost volume profit graph.
Okay, we're not going that far. So for this problem, they tell us that they had sales of 10,000 units. So let's say it was phones. So they had these phones, they had sales of 10,000 units. Each unit was sold at $35, and they had sales of $350,000. And their variable expenses are $200,000. So when you subtract the variable expenses from the sales, we get our contribution margin. And then from that, we subtract the fixed expenses, which in this case is $135,000, and that gives us a net operating income of $15,000. So what we want to do is look at these different scenarios. So one scenario is that we're going to have a sales volume of 10,100 units. The second scenario is that we're going to have a sales volume of 9,900 units. And the third scenario is what? Sales are going to decrease by 1,000 units. So we'll sell 9,000 units. And at 9,000 units, what do you think is significant about 9,000 units in this case? Just if you were to guess.
Below your break even.
What is it?
Below your break
Well, wait a minute. You guys are saying two different things. All right, Damon, go ahead. Tell me what you say.
even. Below the break even.
And yeah, it's the break-even point. 9,000 units is the break-even point. So now we're going to see why. So we talked about the break-even point and the margin of safety. Now we're going to see through this example what we mean when we say at that level we're going to break even. All right, so this is for the first scenario. So sales, how many units are we going to sell?
10,000.
10,100. So how much of an increase is that? Yeah, David? 1%, right? All right, so they tell us that they're selling them at $35 per unit, right? Go ahead.
The October price gonna be 643,500.
350.
Check it again. How many, at these number of units, how much is the sales gonna be?
353, 500.
Okay. Is that what you got, Elaine? Okay. And then the variable expenses. All right, think about this carefully now. What are, at 10,000 units, what is the variable expenses?
Should be a 10% increase, right? Be a 1% increase.
So what is the variable expenses gonna be now? Okay, who could tell us how they got 202,000?
Multiply by 1%.
Go ahead, Melissa, go ahead, tell us.
It's the 1,100 units times the variable expense per unit price, which will be $20.
So it's the 10,100 units times $20. So the variable expense per unit, they're telling us, is $20. So in the current situation, at 10,000 units, the variable expenses are $200,000. But now, at 10,100 units times $20, we have variable expenses of $202,000. Who can explain how that's possible? How is that possible? What do you mean? We just said, it says in the book, variable expenses, $200,000. Now we're saying variable expenses are $202,000.
Number of units.
We produce more units.
Yes, more units, and so what?
Price per unit.
Is our rent still the same?
Yes.
No, is our property tax still the same? So why? Why is this number going up?
Because of the
We use
units.
more direct material.
So, go ahead, tell us.
We use more direct material
Right,
to make fabric.
more plastic. Right, and more labor too. More direct materials and more direct labor. So remember we said that the variable cost per unit stays constant. Remember, Melissa, we had this conversation about fixed cost and variable cost?
Yeah.
The variable cost per unit is still going to be $20. But the total variable cost is going to increase. So now we're selling 100 more units. We're using more labor. We're using more direct materials. Remember we looked at the coffee example? We're using more coffee beans, whatever it is, and that's why the variable expenses have gone up. So when we subtract from sales the variable expenses, that gives us our contribution margin. Which is what?
151,500.
151,500. All right, now we're going to look at the fixed expenses. So keep in mind the contribution margin does not include the fixed expenses. So here they tell us that the fixed expenses are 135,000. But keep in mind now we're selling 100 more units. So how much is the fixed expenses now?
135,000.
Right. Good, good, good. You guys are getting it. So it's the same. And then to get our net operating income, we subtract the fixed expenses, and we get 16,500. So 10,100 is not the break-even volume. At 10,100 units, we have sales of $353,500, and our net operating income is $16,500. Now let's look at an example where we said what? We're going to sell 9,900 units. So what is it going to be then? 9,900 units. What is our sales going to be?
346,500.
Right, 346,500. And tell us, Melissa, how did you get that?
9,900 times 35.
Right, times $35. Remember, $35 is the sales price. And then the variable expenses, it tells us in the book, it's 200,000. So what are we going to put here? Variable expenses are
198.
how much?
198.
All right, tell us how you got that, Melissa.
9,900 times 20.
Everybody got that? 9,900 times $20. So the variable cost per unit we calculated as $20. How did we get that? How did we get the variable cost per unit at $20?
Was given you.
And how did they calculate it? Right? If they didn't tell us, could we have calculated that on our own? How would we have gotten that? How did they come up with the $20? In some cases, they just tell us. But in this case, if they didn't tell us,
Divide the total expense for number of units. Not the total expense, the total variable expense. To get total variable expense.
so they tell us that the variable expense is
$200.
200,000, and they tell us that the number of units sold is 10,000. And so you divide the $200,000 by the 10,000 units. That's how we get the $20. So that's what we need to do here, is multiply it by $20, which is the variable cost per unit. And then to get the contribution margin, we subtract from sales the variable expenses. And how much is that?
148,500.
Right, 148,500. Now we have our fixed expenses. What at 9,900 units, what are our fixed expenses in terms of dollars? 135? Are you sure? Why? Why is it 135,000? Well, look at this. First we were making 10,000 units, selling 10,000 units. Then we had 10,100 units. Now we have 9,900 units. So our variable expenses went down. So what about our fixed expenses? It's the same. 135,000. So what would be some examples of fixed expenses that we might have? The rent. Salaries, which is not the same as wages. Generally, wages refer to what we pay the laborers, which work on an hourly rate. Mary is not a laborer. She gets paid $195,000 as the plant manager. We're still trying to figure out how we're going to allocate her salary to all these products that we produce. And so what is the net operating income here? 13,500. So what do you think of the business so far? So we're still making money.
Minus taxes, you would be.
What's the who could calculate the percentages here? If sales is 100%, what's the contribution margin ratio? So what percentage of sales is the contribution margin? Siobhan, 43%? So the contribution margin is 43%? And that means that our variable expenses are 57% of sales? Is that right? Who wants to check that? 57% of 346,500. How much is that? How much, Krista? 57%?
We got 57.1.
Okay. And so this total is 100%. All right, so what's the last scenario that we're going to look at? Is,
So volume is 9,000.
right, if sales are 9,000 units. All right, so who could help us with that? So we're going to sell 9,000 units at $35. 315,000. And our variable expenses are
198,
how much?
198,
188?
180.
180.
180. And the contribution margin?
125.
Now, this is where it gets interesting, right? So our fixed expenses are fixed, right? And that's also 135,000. Which means that the net operating income is 0. So that's our break-even point. At 9,000 units, if we sell 9,000 units at $35, then we're just gonna break even. We're gonna be able to cover our variable expenses and our fixed expenses. We're not making any profit, which you might think is kind of surprising with $315,000 in sales. Would you be excited, Dallas? You had a business had $315,000 in sales. It's like, woohoo! Party and party and party, right? But look, we have no income. We have no net income. We're not profitable. What could impact this? What could we do knowing this? Let's say that this was a pro forma analysis. Right? We could do pro forma statements. We could do a pro forma income statement to see what would sales be if. That's what we're going to keep talking about is what if. What if sales are 9,000? What if sales are 10,000 units? So what could we do to impact this? How can we become profitable? What are some of the things that would influence this? Oh, that's weird. You know what it's like to get like 28 people's voice in your head? I have to take my medication. All right, so somebody, what do you think? Tell us. Go ahead, Alex.
Increase the number of units.
Yes, we could increase. We could try and sell more units. How would we do that? Oh, well, wait a minute. Somebody said lower the price. Now we need to really think about that. That's not. We don't know. We need to think about it. It's not like that's just like a bad idea, but we need to know. At this price, we're not making any money. So if we lower the price, let's say we lower it to $30, the question is this an elastic market? So in other words, if we lower the price to $30, are we going to sell more units? Will our total sales be more, right? Will the increase in sales be more than the decrease in price? Now in some markets are not elastic. They're not price sensitive. So if you lower the price, sales will not increase. Lower cost, we could try and send Alex back to Turkey and see if he can negotiate a better deal on the plastic. Right, so what happens if the plastic, if we're able to get the plastic now for $15 per unit, then what is this going to be now? So instead of a variable expense per unit of $20, Alex goes there, we send him first class, he negotiates a deal, and assuming it's the same quality of plastic, and the reason why I mention that is because sometimes we might be able to get, let's say, the plastic for a lower price, but then we have to process it when we receive it. In other words, we have to do something. There's another step in the manufacturing process that maybe we don't have to do now. So like maybe we need to treat it with some type of chemical, or we need to heat it, or we need to do something that we're not currently doing now. And maybe the less expensive plastic reduces our efficiency, and we could only produce, we could produce less units with a similar amount of plastic. So price is not everything. Don't be tricked that we think, oh, well, now we're getting plastic at a lower price. There's some trade-offs. We're going to talk about that too, about labor efficiency and operating efficiencies, because we want to know how well we're using our resources. So sometimes we save on one side, but then lose on the other. So we might get cheaper plastic, but then maybe we have to use more labor. So what is it going to be then? So Alex negotiated this better deal for us, $15 per unit produced. So what is our variable expense going to be now? And then our contribution margin is going to be, what's our new contribution margin? 180,000. And what is our fixed expense going to be? You guys. And so what is our net operating income going to be now? What's that? 45,000? $45,000.
I just have a question on the second half. Is that supposed to be 20 or 25?
Where? Oh, here?
Yeah, 20.
Oh, 20.
Oh, that's
20, right. So we said reduce our cost. So we reduced the cost of direct materials from $20 per unit to $15 per unit. And now instead of breaking even, instead of our net operating income being zero, now it's $45,000 for the same number of units. We're still selling the same number of units. So we reduced the cost of our direct materials. Maybe we could negotiate a better deal with the union and reduce the cost of direct labor so that the hourly wage for the workers is less. What do you think? You don't like that idea? Okay. And we could consider lowering the price. If we lower the price to $30, and then let's say we sell, well, let's look at that. Let's say we lower the price to $30. So let's say we say 45,000 is not enough. That's not enough of a return on investment. So if we lower the price to $30, and then we are able to sell at that price, let's say we lower the price by 10%. So that would be what? $31.50? So now we're going to sell at $31.50. And let's say at that price, we could sell 15,000 units. Now let's see what impact that has. Because Odalis is right, maybe we should lower the price. That's certainly, from a marketing perspective, there's 4 Ps. The 4 P's of marketing, the marketing mix is price, place, promotion, and product. So Adalis is right. We could lower the price. That could, in an elastic market, that could increase sales. So let's see what's going to happen. So what's going to happen to our sales? Now instead of selling them at $35, we're selling it at $31.50. We lowered the price 10%. So what is the new level of sales going to be? 472,500. And our variable expenses?
Should raise them back to $20.
You want to raise it back to $20? Okay. So now we're assuming we're just going to lower the price. We're not gonna send Alex. What, I don't know, Alex, if you want to go on the trip or not? They're saying maybe we shouldn't send you. If we're gonna, maybe we should just lower the price before we send you to Turkey for a month and pay all your expenses and, you know. So what do you think? You're gonna go? Or no? Damon says he doesn't want to send you. All right, so let's wait. Let's wait. Let's see what happens if we lower the price. So then what are our variable expenses gonna be? 300,000. And then our contribution margin is? And our fixed expenses are still 135,000. And our net operating income now is what? So what do you think? Did we do the right thing?
It's 37.
What do you think of Dallas? We took your advice, we lowered the price 10%. What happened? Sure, we're profitable. Our net operating income is 37,500. What was it before?
0. If we kept the
Right. If we kept the variable expenses, if we didn't get a cost reduction in direct materials, we lowered the price from $35 per unit to $31.50, which is a 10% decrease. But in this case, we're assuming that with a 10% decrease in price, we saw how much percentage increase in the number of units sold? 50%. So price is something definitely we could do to influence this. What about advertising? We could spend more money on advertising. Absolutely, our fixed expenses are going to go up. So we could build awareness, we could spend money on advertising, build awareness. Ideally, that's going to increase the number of units sold. What else can we do? Get more distribution. We can fire the manager? Yeah, maybe. We might decide to fire the sourcing manager or the plant manager, or maybe we'll just decide to fire the accounting department. All right. Place is distribution. So place would be, in this case, we could say, well, instead of just selling our phones at Best Buy, now we're going to expand distribution and sell them at Walmart, at Kmart, at Target, at where else? Macy's. I was going to say Circuit City, but they went out of business. Probably because they couldn't do this contribution format, right? That was the problem. They couldn't anticipate what would happen if they lowered their price and the impact that would have on demand. Questions about this? How we we're doing on time? We're here till midnight, right? All right, the one that I want you to do for homework is problem 618. All right, let's look at exercise 6. All right, so we're gonna, very often we're trying to figure out what the plug number is. We're not always gonna have, or be given all the information. So we need to calculate some of the information. So in this case, what we wanna do is, we wanna look at a situation similar to what we were doing now, but now we're gonna go through the calculation to see. Suppose that Bill Keys tells us, you know what? I think that we need to have a profit of $100,000. So then we say, well, how much was our profit last year? Maybe we'll say, well, is that reasonable? Because as managers, we want to have goals that are reasonable, that are attainable. We want to challenge people to try and do better, to work harder, to be more productive, but we got to say, is that reasonable? So in this case, maybe we think, you know what? Yeah, we could go from 37,500 to 100,000. But then what's the next question we're going to ask? What is the next thing that we're going to need to figure out? Because now, once Bill Keys tells us we need to make $100,000 in profit, we need to figure out what the price is going to be. So what price are we going to charge so that we could generate $100,000 in profit? And how many units are we going to have to sell? So sometimes we could kind of figure that out intuitively. But most of the time, we need to do a calculation to determine that. So that's what this problem looks at. It says that Lynn Corporation, they make only one product. They have a single product. And they sell their product at $120. And they have variable expenses of $80 per unit. Their monthly fixed expenses is $50,000. So now what we're going to do is it says, if our target profit is 10,000, how many units are we going to have to sell? Isn't that basically what we were talking about when we're going through these different scenarios to see, right? Or Dallas said, well, what if we lower the price? And then somebody said, well, what about if we reduce the cost of direct materials? So those things can impact our profits. But then we need to figure out, once we have that goal, once we have that target, the question is, how are we going to achieve that? Because look at the different scenarios that we looked at. Because right now they're telling us that they sell their products at $120. Do we lower the price? How many units do we need to sell to make $10,000 of profit?
I'm doing exercise 6-6, right?
Right. Right, on page 292.
Can I give you the answer?
So ready, you got the answer? You got the answer too? All right, go ahead, tell me how you calculated it.
Well, can I tell you the answer and then can you tell me what?
Okay. All right, go ahead, tell me what you got.
1,500?
Yeah.
Yes, okay.
I'm not sure if I did it properly, I did it my way.
Yeah, I saw some of that on the exam.
I did it my
I was
way.
reading, when I was grading the exams, I somehow turned them like this.
I did
That.
I did it my way.
It
and what
was
made
amazing,
sense.
the way these people write.
And what made sense to me in my head.
I've never seen Schedule of Cost of Goods Manufactured written that way before. Writing stuff on the side. Okay.
I took the $10,000 that they wanted the profit, and I
Right.
added it to the monthly fixed expenses.
Yes?
Okay, so that brought me to 60,000. Then what I actually did was 120 per, per unit, whatever, and I subtracted the 80, which brought me to 40, and then I divided the 60,000 by 40, and that's how I got that.
Oh, I see. Okay, so this is 60,000. You divided this by
Right.
40. How'd you get to 40?
The $120 per unit minus the $80 per variable expense.
All right. And what is this called? This here. What Flatliner calculated. This is the price minus, what is this?
Variable.
Variable, right? That's the variable cost per unit. And in this case, it's $40. And what do we call that when we subtract the variable cost from the sales price?
Contribution margin.
Okay, somebody's saying it.
Contribution.
Right, that's the contribution margin. The contribution margin is very important because what it does is it isolates the variable cost. So what we want to do is find out the cost that we could influence. Right? The fixed cost we can't change, right? I asked you guys like 6 times, you tell me no, fixed costs are costs that are fixed. And it's $135,000. So it's important for us as managers to look at the contribution margin, which is the sales minus the variable cost. That's what we're going to try and influence. The fixed costs, we need to know what the fixed costs are, but it's unlikely that we're going to change that or be able to influence that within a relevant range for this particular product. So then you got 1,500. 1,500 units. All right, so tell us what that means. What is that 1,500 units?
We need to sell 1,500 units to make a profit of $10,000.
Right, everybody got that? So what we calculated is how many units we're going to have to sell at $120 with a variable cost of $80 to make a profit of $10,000 when the fixed costs are $50,000. That's known as the formula approach. All right, so I'm going to write the equation on the board. Did everybody get 1,500 units? So it's the units to be sold is equal to the target profit. In this case, we said is 10,000 plus the fixed expenses divided by the unit contribution margin. And that's exactly what Flatliner explained to us. That's how we got 1,500 units. We said, they told us in this problem that the target profit is $10,000. The fixed costs are $50,000. And the unit contribution margin, we said we calculate by taking the sales and subtracting the variable cost. And in this case, we said the sales price per unit is $120, and the variable cost is $80 per unit, which equals $40. So 10,000 plus 50,000 equals $60,000. Divided by $40 gives us 1,500 units. So at this price, at $120, we need to sell 1,500 units to be able to make a profit of $10,000. What about if we want to make a profit of $15,000?
1,625.
All right, so let's see how we got that. So now we want to see how many units we're going to be able to sell, we need to sell to make a profit of $15,000. So who's going to take us through this to see how we got it? Come on, this one we did, we said our target profit is $10,000. Now we're saying, you know what? We really need to make a profit of $15,000. Go ahead, Melissa.
Let's call units letter K, just to make it easy, okay? So it's 120K.
So where are we?
Right?
So what's the target profit?
15,000. You wanna do it like that, or you wanna do it the quick,
No, let's stay with this, with the formula approach for now. Then we'll do the other one.
Okay. 15,000,
Right, 15,000 is what?
the target profit,
All right.
plus 50,000 fixed cost,
All right.
divided by unit contribution margin, which is the same 40,
So it's $120 minus 80,
equals
$40. So what do we get up here?
1,625.
65,000 divided by $40 is 1,625 units that we need to sell to make a profit of $15,000. Is it important to know this? What do you think? I mean, you see where this is going? Based on what we started to talk about at the beginning, the first problem that we looked at.
Does it matter whether we do the equation or the formula?
No. So if we change, let's say that we changed let's say now we decided, you know what? We're going to really push the envelope and we're going to set a goal of that $100,000. So now, who could tell us what's going to happen here? How many units are we going to have to sell to make a profit of $100,000? Who's going to tell us? Did you eat your apple? How come? What's the matter? Are you okay? Oh, you have a toothache? Okay. Yeah, I noticed you were very quiet today. All right.
3,750.
Wait. Let's go back. So who can explain it to us step by step? One more time. Who can do it? Somebody. Come on. Don't be shy. Anybody. Come on. You don't want me to call on somebody, do you?
What's the question now?
Come on. See what I mean?
Same question.
Come on. Who could help us?
$1,000.
Crystal, right? Krista or Crystal? Which one?
Okay, 100,000
100,000
Yeah.
is our target profit.
plus the fixed cost, which is 50,000.
Good.
Cost again? The-
All right, so we need to figure out the unit contribution margin,
Yes.
which is the sales minus the variable cost.
Which is the same 40.
Right, so it's still $120 minus the $80, which is the variable cost per unit, which is 40, and is what, how many is that group? Is that group with 2 O's or 3 O's?
3,750 units.
How many?
3,750 units.
3,750 units. So for, let's look at this. At a target profit of 10,000, how many units did we need to sell? 1,500. And at a target profit of 15,000, how many units did we need to sell? And a target profit of 100,000, how many units do we need to sell? You sure this is right? Anybody check it?
Not trust.
Now, what do you think? Does this surprise you?
Yeah.
Who could explain what's going on here? What do you think? At first you probably said, wait a minute, first we're talking about $10,000 as a target profit. Now you're telling us $100,000? You're crazy. Not laugh at me, you know? So I can give you one lick. So who could explain this? Go ahead, Mackenzie, go ahead.
First, you have to take into account that it takes 1,250 units to break even at all. So at that point, it's 250 units for a $10,000 profit. And what is it? 2,000.
All right, so how many units? Let's see. So tell us, so the break-even volume, that's good. Let's see, how much is that? You said that to break even, which means the operating profit is 0, is how many, Mackenzie?
1,250.
All right, so at this level, what is the margin of safety?
250 units.
250 units, which is equivalent to how much in sales?
$10,000.
So at 10,000 units, a profit of $10,000, we have to sell 1,500 units. But the margin of safety at this level of $10,000 in sales is, no, not in sales, wait. How much is it? $120
Right.
times
1,500 units.
is how much?
See, this is the question, right? It's 180,000. See, it doesn't work out that way. The way I did it.
Right, so that's not the margin of safety, but, so let's see, so this is $180,000 in sales.
It's 180,000, right? And then the variable expense is 80,000 in the second question.
Right.
So the contribution margin equals 80,000. Then the fixed expenses is 50,000. So 80 minus 50, 30. You know, I mean, I'm not getting the whole.
Which part?
All right. Remember the first example? we did?
Okay, all right, so let's leave this for now. We'll come back to this, we'll calculate the break-even volume. But this is $180,000 in sales, right? And what about for at unit sales of 1,625? 195? Is that right, 195,000? Okay, and at 3,750? Should what? 450,000? Trust? How are we doing? Are we good on trust? Is that right? So 3,750 units times $120 per unit? So now who can explain what's going on here? Because you probably thought, oh, that's $100,000. No, that's ridiculous. That's not reasonable. 10,000, okay. Well, you want to make it 15,000? All right, we'll push ourselves. But $100,000 from 10,000 to $100,000? Adios mío. It's a problem, right? What do you think, Dallas? So what do you guys think? Now our target profit is $100,000. Who could explain why the numbers worked out this way? Because look, this is 1,500 units, and now we only have to sell another 2,250 units. Maybe you thought, oh, we're gonna have to sell like another 10,000 units, or why? Why is it like this?
Profit margin is high, so you don't have to sell that many units to make that much money. That much profit.
What does that mean? What does that mean? The profit margin is high.
Well, if something costs you $20, you sell it for $100, again, the profit margin is 80. If something costs you $20, you sell it for $25, the profit margin is 5. So if you have a high profit margin, like this seems to be, you don't have to sell as a huge amount of units. You could just sell 2,000 more units to make 100,000 in profit, as you said.
Anybody want to add to that? Olga, go ahead.
Maybe because fixed cost per unit, it's different.
Yes, go ahead.
So if we divided fixed cost 50,000 divided on that 375 units, the fixed cost per unit would be much less.
Right. So each additional unit that we sell is absorbing a percentage of that $50,000 of fixed cost. So as we're producing, the more units that we're producing, the smaller the amount of fixed cost each unit has to absorb. Which means as we increase the production quantity, we're becoming more profitable. Right? Because we're spreading the fixed cost over a greater number of units. And right now we're looking at the unit level. Right? How many units we would have to sell. The variable cost per unit is still going to be $40. So we're selling more units. Our total variable costs are increasing. The variable cost per unit is unchanged. The total fixed cost is unchanged, but the fixed cost per unit is declining. In fact, it's going to decline very significantly because here we're spreading the $50,000 of fixed cost across 1,500 units, and here we're spreading it across 3,750 units. And so that's why to go from 10,000, a target profit of 10,000, to 100,000, because right, this is a tenfold increase. Right? How many fold increase is this from 1,500 to 3,750? What is it? The 2 1/4, 2 1/2?
2.5.
2 1/4? So we changed our target profit by 10 times. But in order to achieve that, we only need to sell basically roughly 2.5 times as many units. Yeah, Greg?
All right, I just have a question. In the first example, remember with the sales, variable expenses, contribution margin, fixed expenses, and that gets you the net operating income. So if I apply that to this, it doesn't seem to work out in terms of the numbers. At least maybe I don't understand it. So like, for example, for sales, for the first one, it was 120 units times 1,500. I mean, $120 times 1,500 units,
Right?
which gets you 180,000 in sales.
Right?
The variable expenses on that would be $80 per unit times 1,200, because that's the amount of units. So that gets you 96,000. So if you take 180 and minus 96, that gets you 84,000 for the contribution margin.
So
It's the
180,
same amount of units, it's the 80 times the 1,500.
180,000 is 1,500 times $120,
Correct.
That's
So
the
that's,
sales.
so that's the sales.
right? And then the variable cost is,
The variable,
It's
variable cost is $80 per unit, and we sold 1,500 units.
right?
So 80 times, I already.
That's 120.
So 80 times 1,500
It's 120,000.
is 120,000.
What did you say, 96,000?
He did the
Yeah.
times 12.
That's because I multiply by 1,200 instead of 1,500. All right, so that gets you 60,000 minus 50, 10. Beautiful. My math is wrong.
No, but that's good. I'm glad that you brought that up. Everybody see what Greg is talking about? 1,500 times $120 per unit, that's the price. Gives us 180,000. Then, we have to subtract the variable cost, which is $80 times 1,500 is 120,000. When we subtract from the sales, the variable cost, we have a contribution margin of 60,000, and then we subtract the fixed cost of 50K, right? Gives us 10K.
Thanks.
Are we good? Are we great? All right, we still got 3 more hours, right?
No, we didn't.
It's not, it's not midnight yet. Questions?